As of February 2025, the Buffett indicator has reached 203.51%. While this metric alone doesn't necessarily mean that a crash is coming, it could be wise to start taking precautions just in case. To protect my personal portfolio, there are 3 things I'm doing right now. It's always a good idea to have some cash stashed away for emergencies, but it's extra important when a market downturn could be looming. If stock prices fall, your portfolio could lose substantial value in the short term. As long as you stay invested, though, you likely won't lose any money. The market will eventually rebound, and your portfolio should regain any value it lost. However, if you pull your money out of the market after stock prices have dropped, you could end up selling your investments for far less than you paid for them, potentially locking in steep losses. If you don't have an emergency fund and you face an unexpected expense during a market slump, it's more likely you'll need to tap your investments at a less than ideal time. When the stock market is thriving, sometimes even shaky stocks can perform well. But a market downturn is the ultimate test of a company's fundamentals, and weak businesses will often struggle to survive tough economic times. The best way to ensure your portfolio pulls through the next bear market is to double-check that every stock you own is still a solid investment. Companies can change over time, so even if one of your stocks was a fantastic buy when you first purchased it, that doesn't necessarily mean it's still a strong choice now. Stock price alone doesn't necessarily reflect how strong a company is, so it's wise to look at metrics beyond this number, like the business's price-to-earnings ratio and its price-earnings-to-growth ratio. It's equally important to examine big-picture factors too, like whether a company has a durable competitive advantage that can help it keep up with industry changes. A competent executive team is also critical, as bad leadership can cause even strong companies to struggle. The future is uncertain, and that can be incredibly nerve-wracking for investors. If you're feeling scared about what may be in store for the market, that's normal, and you're not alone. In times like these, looking back at the market's long-term history can be helpful. In the last 25 years alone, the market has faced the dot-com bubble burst, which became one of the longest bear markets in S&P 500 history, the Great Recession, the COVID-19 crash in 2020, and the most recent bear market throughout 2022. Despite all of that volatility, though, the S&P 500 is up by more than 300% since 2000. If you'd invested $10,000 in 2000, you'd have nearly $41,000 by today, even after accounting for all of the severe ups and downs in that time. As daunting as they are, downturns are a normal part of the stock market cycle. While you can't avoid them or predict exactly when they'll begin, keeping your focus on the years ahead can make it a little easier to get through them. It's tempting to try to figure out where the market is headed and adjust your investments accordingly. After all, if you can sell your stocks at peak prices right before the market falls, you could make a hefty profit. However, if history shows us anything, it's that nobody can predict exactly where the market is headed in the short term. And if you buy or sell at the wrong time, it could be costly. This isn't to say that these experts aren't skilled at making predictions. Rather, it demonstrates just how unpredictable the market can be. Many economists and financial professionals have been warning that a recession is imminent, and yet the market has been thriving for over 2 years now. Of course, that doesn't necessarily mean that a recession isn't right around the corner, but the market's unpredictable nature makes it much more difficult to gauge when the next downturn will begin, which can make times like these even more anxiety-inducing for some investors. There's a major silver lining for investors. Nobody can say for certain where the market will be in 2025, but the good news is that with a long-term outlook, it's much easier than you might think to protect your investments, even if we face a recession or market crash. If stocks take a turn for the worse, your portfolio could lose value in the short term. But losing value is not necessarily the same as losing money. As long as you stay in the market until stock prices recover, you'll likely regain any lost value and end up back where you started. For example, say you invested in an S&P 500 index fund in January 2022. Immediately before the market began its descent that would last until October of that year. If you had panicked and sold your investments in, say, March, you'd have locked in losses of close to 10%, even though the worst of the downturn was yet to come.